This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com. It's my pleasure to have back with me again this month Charles Hugh Smith, well-known and prolific writer on the web, who is the publisher of the website of2minds.com. Good morning, Charles.
Good morning, Gordon. Always glad to be here.
Well, at my age, I'm glad to be anywhere, so on my end, but I always enjoy our talks, and always the subjects we pick are things that are on our mind. But this one really is something that's been troubling me for a while, of what we're doing with the capitalist system. So I thought we'd just jump right in, and that is the amount of money that we're taking out of the system on a regular basis. The Wall Street, if I can use that, but the financial community, that there's nothing wrong with profits, and I don't mind money being taken out, but it is not going into productive assets. It's the whole purpose of Wall Street is the reallocation and the proper allocation of capital. And they deserve to be paid well for that if they do it right. But I'm talking about money that doesn't create jobs, it doesn't create growth, it doesn't improve productivity. It's no value other than, I'll use the word graft on that. And I know you've got some comments on that before we get, I want to go into three of them here today.
Yeah, go right ahead. Let's get started, because what we're really talking about is the fundamentals of our economic system.
Yeah, the first one that really jumps out at me is high frequency trading. And there's different versions of it, dark pools, etc. But just talk about high frequency trading that's going on. What value does it add in trading in microseconds? And people need to understand, we're not talking about the equity markets just. We're talking about the currency markets, trades 5.6 trillion a day. We're talking about bonds, commodities, anything and everything that trades today is using these kinds of techniques. And it just pulls out, quite literally, billions and billions of dollars. Now, if it pulls it out in that fashion, it's not being plowed back as investment. And you and I have had many conversations where capitalism is about savings. And savings, another things we've talked about is there are no savings in the world. But a corporation makes a profit, has to reapply that profit into productive assets that's going to generate productivity. Productivity will increase your standard of living. Well, it creates jobs, which creates standard of living. With this money going out, it's literally strangling capitalism. And if it was a small amount, fine. But this is now measured in the hundreds of billions of dollars. Do you agree with that observation?
Absolutely, and it's a statistical fact that if we look at the financial profits as a percentage of total corporate profits, we see that financial profits have risen enormously in the last decade or so as a percentage of total corporate profits. And so what we're seeing is the financialization of our economy, where the profits that people are pursuing are coming from high-frequency trading and basically gaming the financial system, rather than investing in worker training, more productive facilities, what we call CapEx, capital investment. And then you've often mentioned this, Gordon, that companies have to make a profit, not just to return a profit to their investors or owners, but to invest in future productivity, because that's the engine of future profits.
I don't begrudge anybody making a profit. Matter of fact, I applaud anybody that's creative and innovative, and I applaud the high-frequency traders for being so innovative. But at the same time, we have to make sure that these things are going to be constructive to our society. And if it's simply killing the golden goose and robbing the money for investment, the potential investment, it's incredibly destructive, because our top line growth in corporations today is not there. We're not getting revenue growth. We're not getting margin growth. Up until recently, we've been getting earnings by laying off, cutting people. But at some point, you can't just keep laying off people. You've got to grow organically. Now the game is to do an acquisition of somebody else and then strip their company down. Slow, as obvious as that is, and everybody says, Gord, you're not telling me anything I didn't know, but it's been going on for 15 years and high frequent, or 20 years, and now we're seeing it. Now we're seeing our economy just strangling. And I know you've had up a number of charts that just show the middle class, the degree that it's being gutted, and the real disposable income that it has even to buy consumer goods today. And in a 70% consumption economy, I think that's called checkmate, isn't it?
Right. And, Gordon, because we're been working for 45 or 50 years, we can go back and you benefited, say, I'm just going to refer to your past. You benefited from IBM investing in its people. In other words, its core, one of its core investments was in its own managerial class, bringing people along, training, advancing people. Now, if you get a job, you're expected to do the job on day one without any training. And when you've done the job, you'll probably be laid off because you're interchangeable. No one's going to invest a dime in you. They want to extract your labor, maximize what you know, and then, forget it. You're gone. And so what kind of investment are we making in the workforce? And for most companies, the answer is very little because they feel they'd rather poach somebody who already has the skills from a competitor. And so a lot of young people, we see they're frustrated because they don't have the skills to generate value on day one, but very few companies are willing to hire them and bring them along and to give them those skills.
It's not even in the vernacular. I mean, you're expected to arrive and be able to do the job. And by the way, as soon as things are changed and you're obsolete, you're gone, and you have to reinvent yourself. I can understand all that, but it's the fact that companies, cost has to be an incredibly important driver, but investment is more important, and how you invest. And it's not just investment in capital goods. You have to invest in your people. And investing in your people that gives them the skills is going to make the company and everybody more productive. But we're cutting corners. You mentioned IBM. And so we have so many young listeners that probably just don't have the perspective that us older guys have seen. When I joined IBM, they made me go to school. This is after graduate school. I had to go to school in New York for a year, classrooms, being trained before I was allowed to go into a branch operation and actually meet a customer. Because they didn't trust me to talk to a customer until I trained. And then I was a trainee at that point. And then you had to kind of work your way up until they trusted you with a customer that might be important. But this was just the way it was. Today, there's none of that. And I'm not trying to get into the past. It's this investment. Now, why aren't companies making this investment? And that in itself is a real issue. But I'm also arguing here that the companies are making profits, but there's so much that's being bled out of the system. And this high frequency trading is classic. And we can talk about other techniques like dark pools, etc. The second one that I find troubling, and I've written a lot on this, is stock buybacks. Buying back. We had 1,900 companies at the end of last year, the S&P, that actually spent more money on buybacks and dividends combined than they did that they actually made. They didn't make that money. 1,900. They borrowed the money because it's so cheap to turn around and hand it out. Now, does that? It makes no sense unless you're trying to take yourself private and you don't see any growth. It's not worth investing in you're not real, well, I guess you are investing in yourself, but you don't see the real growth. So you get your total number of stocks down. But there's nothing productive in that. It doesn't help society.
Doesn't create any jobs, doesn't really add any new product or service. Gordon, I want to mention 3 points here. One is we talked about productivity. Well, there was an interview, I believe Bloomberg interviewed Alan Greenspan, and he said productivity is dead. And so we're starting to reap the consequences of this financialization in that our productivity is going down. And as you said, your productivity is the engine of your standard of living. And so we're really impoverishing ourselves because we've incentivized this kind of gaming. And I think we need to bring in the Federal Reserve and the federal government because if interest rates weren't 1%, I mean, companies can go out and borrow $100 million at 1% and then buy back their stock, push the stock up 10% and make $1 billion, off of that 1%. So why is money at 1%? Well, we get distortions when money is near zero. And this is a classic example, stock buybacks. If you're a manager or a top executive or connected to the hedge funds that own the corporation, it makes no sense to do anything to risk that $100 million in increasing production or improving your productivity. It's obvious. Go buy the stocks back, push the value up a couple billion, and then sell your shares.
There's no incentive to take risky bets that are longer term. Everything's short term and more immediate. I can understand that, and you and I have had this conversation. What built America were people making major bets, whether it was the Rockefellers in oil, whether it was Carnegie in steel, whether it was the Vanderbilts in railroads. If you look at every major industry, somebody bet their life and a fortune, and they pulled it off. And it's what made America. It built industries. And I don't think that's something that's historical. It is historical that way, but it's something that should be going on today. Nobody takes those bets anymore. The money's there, but nobody will take the risk. So we're not creating new industries. I mean, there's industries ready to explode, but if solar energy, different energy sources, but nobody will play that kind of money. And that short-term financialization is causing us problems. And unintended consequences of this too, Charles. Just the last point I make on buybacks. I've been doing a little study trying to figure out, well, who's wanting. I know why the companies would want to do the buybacks, but who's lending these companies through their bonds the money to buy it? What thinking? Why would you buy their bonds, especially with their credit now starting to suffer because they have so much debt? So where's this money coming from? And from the bonds. Well, when I look at it, you know that most of these companies have $200 billion in offshore profits that they haven't repatriated to America. Apple, IBM, we can go through all of them. So they're sitting offshore, and someday maybe they'll come back, but then they'll pay taxes. If you've got $200 billion sitting offshore in an account, what are you going to do with it, Charles? Just let it sit there and do nothing? Well, you know what to invest it in. Your company is investing. Wouldn't you just put it in an SPC, which is a fancy thing like Enron did, and then as an investment entity, and it buy your bonds? So you buy from your SPC your company's bonds. You use the money to drive down your share price. At the end, and you're not paying anything to bond. And at the end of the day, the money just goes back to your SPC, and your stock prices is up. Nice little hat trick, right? No tax, no nothing, except you got a tax write-off on borrowing the money.
Wow. Very slick system.
Isn't it? Well, I'm just trying to give you examples of the unintended consequences that are going on here. Now, why would we get? Where is the productivity in that? Where is that investment? That is just gaming the system. And my hat's off to people that are successful at it. But we've got millions, and we have 50 million people on food stamps right now that would like to have jobs and employment. And our system is not constructed to do that any longer. And buybacks is another example where we're just stripping the money right out of the system. I don't mean to get a little bit of energy on this, but I want to know where our regulators and our politicians are to try and create the right balance. I'm not looking for more regulations, but the system has become almost totally lopsided. Comments on that? Sorry to be long-winded.
No. It was all you were making the points we wanted to make here, and I think we can look at the tax structure as one example. Like, in other words, if high-frequency trading was taxed at, say, 48% or 50% for short-term profits, and say normal corporate profits from investing in new products and services was taxed at, say, 1%, I mean, essentially zero, no corporate tax, well, where do you think the money would start going? And obviously, people would be more willing to invest in new products and services if they were paying zero tax on their profits and they were paying 50% tax on their financialization profits. So there's an example right there. But speaking of skimming and lawnmowers, you've got a slide here on the carry trade.
Yeah, there's another one. Do you want to explain that to some of our listeners how that one works?
Well, Gordon, you've created a great slide here of how the carry trade works in that it's a sort of circular function where if I can borrow money here in the US for 1% and say Argentina's got a bond that's paying 8%, well, there you go. I'll go and buy that bond and then
all day long, right?
yeah, and then the 7% is skim is mine. And I didn't create a single job. I invested in no new services or plants, and I didn't gain any productivity, but I made a lot of money.
Here we have all of our pensioners, 75 million baby boomers retiring, 10,000 a day. They're not, they want some money they've saved all their life. Let's assume they got a $500,000 in savings. What are they being paid on it now? Next to nothing. So we're charging, let's say they're picking 1% on it, not 6% or 7% that we used to have. That's because we can argue what's going on with our monetary policy. But now you can't get the money at 1% or a half. The banks get it at a half, 1%. They don't invest it in Americans. They don't invest it in the children of the pensioners that are retiring. That money turns around and it goes, as you just said, to some other country that's paying 7% and they pocket the difference. Where is the advantage to anybody other than the people working the carry trade? Charles, to such an extent that we had something like $7 trillion since we started quantitative easing in America that's left this country, that's went into emerging markets because of this differentials. Now, some of it was an investment, but certainly wasn't investment in America. And people have been making a fortune at that. And again, I have no problems with people making a lot of money, but it's not helping the economy.
Right. And Gordon, we've talked about the death of the middle class or the erosion of the middle class a number of times. And we have to mention here, all this money we're talking about, high frequency trading, stock buybacks, carry trades, all this money goes to the very top, the apex of the income pyramid. In other words, it's only people who own a lot of assets, they own a lot of shares, they have stock options, they own a big chunk of a hedge fund. So that's a big driver, is that you're not going to share this all these proceeds. They're going to the top of the financial pyramid, and the bottom 95% are gaining essentially nothing out of it. And yeah, well, I'm sorry, go ahead.
No, I just going to say, and as you say, their investment is not to go out and buy a lot of widgets that then gets more jobs and more manufacturing going. They're going to invest it in financial instruments again. So whereas with the money was flowing to the middle class, it starts to drive everything from homes to beds to cars. The money flow. But when the top half of 1% are getting all the wealth, where's it going to go back into? More financial products. They're going to be. They'll want to own a hedge fund. They're going to want. All this skimming reinforces itself. I'm not trying to be a do-gooder here, but we're destroying the capitalist system without knowing it. We're not allowing the capitalist system to do its job, to reward people that'll take risk. It's actually penalizing people to take risk.
You're absolutely right, Gordon. That's the key takeaway from our program is what you just said. We're destroying capitalism, and we're creating disincentives for investing in real things and taking risk, and we're incentivizing skimming and lawn mowing. Gordon, I want to mention one other dynamic here. And, you've noticed, and you've talked about it on other programs, that hedge funds and private wealth funds, their returns have been declining. A lot of these shops are closing up and returning the money to their investors because they can't even beat an S&P index fund. And the reason why is everybody's investing in the same, math and physics PhDs to create these skimming machines. And now everybody's using the same skimming algorithms, and then they lose their ability to do the skim. Everybody's playing the same game.
Well, the reason we called this show the Lawnmower Economy, and you and I had talked about it, but it came from a call that I was on, very intense call, and somebody who had a number of rocket science, PhD quants, had come up with a system that they were using. Then they knew nothing about the stock market. It was meaningless to them. It was pure mathematics and algorithms. But this system they had was working so effectively they referred to it as just taking the lawnmower to the market every day. And that's how it's working. And where all the power to them. Now, where's that money going that they're making? Is it going into productive assets? It's buying maybe a couple, 3 or 4 McMansions, and a huge yacht maybe, and
Right.
and probably, I just speculated, some major offshore untaxable bank accounts.
Right.
So how does that help all of the people who are honestly trying to raise families and do the best they can? The system isn't working for them. And I
That's
think,
right.
Charles, I think that's what's going on now. And I don't get political in our primaries, whether it's the Democrats with what's his name now? Help me there.
Bernie. Yeah. Bernie Sanders.
Bernie Sanders, who's got tremendous following with the youth, who are they're disgruntled, and then we got Trump, also people that are voting with their middle index finger, and because they don't know what the problem is, they just know the system isn't working and it's not fair. Remember when we had Wall Street lobbying and demonstrations here a couple of years ago, and but it's been building and it's building, and people can't put their finger on it. But I think the things that we're talking about, if they were close to us, they would be saying these are the essential issues.
Right.
That this is what they know is wrong, and why it's not working. And it's killing the American dream.
Right. And, Gordon, just to end on a positive note, there are things that can be done at the top level of our system. Like, for instance, I mentioned the tax structure. If you want to incentivize risk taking and, investment in products and services and people, then you lower the tax. And frankly, I think the corporate tax should be zero for that kind of capex and risk taking in real goods and services. I mean, because if they distribute dividends, the dividends are taxed as real income. So get rid of the corporate tax, and then tax the heck out of high frequency trading profits, any kind of short term financial profits. Tax it at 50 or 60%. And guess what? You'll see money flows start changing because we've created new incentives and new disincentives.
Charles, unless we do something, it's going to change our society profoundly. And some of the stuff is irreversible. And we're at a very critical time right now. I think, we've had this tremendous 60 years of prosperity in North America, but we're allowing our system to kill itself with faulty regulations, poor public policy, and frankly, just being naive to what we're doing to it. I guess nothing is irreversible, but I think some of this is so blatantly obvious and it's so clear. And you've written extensively and about these kinds of issues that it's shocking to me that it can't be part of the political agenda. But then that's another show, isn't it?
Yeah, well said. Because we mentioned regulation. It turns out there's very little regulation of all these lawnmower operations, and yet there's immense regulations if you want to go out and start a bricks and mortar business. Oh my gosh! Then you've got 3 levels of government, permits, fees, workers' comp. Your expenses and risks are extraordinary. So clearly, we've created, as you say, without really intending to, we've created an economy that it makes it a very risky and actually foolish bet to invest money in products and services when the easy money is in the financial side.
Yeah, why take a risk? It's human nature. We won't do it unless the rewards are really there, and the rewards just aren't there anymore to the same on a risk adjusted basis. Charles, thanks for listening to my rant here today. I had to get it off my chest. I'm sorry to our listeners, but occasionally I just get really angry with what's going on here. And I have the pleasure of doing so many interviews through the Financial Repression Authority with some of the best minds in the world. And I've got to tell you, Charles, they share the same feeling. They may not talk about it publicly, but they're consistently when I get them offline, very concerned about what's going on. And because they see it. I mean, they see it in front of them every day with what they're doing, whether they're economists, they're investors, they're bankers, whatever industry that they're in. So maybe I'm talking to so many of them, I'm starting to really feel their pain too and their troubles. Because they want the best things for their kids. They don't want to just make a lot of money. Because they don't put that on your tombstone how much money you made, do they? They want to leave the world to a better place than when they arrived, and they've reached that stage, and they're frustrated at what they're seeing going on. So I don't know what we'll talk about next month, but I'm out of here. I'm going off to cut the lawn.
Okay. Well, I think I appreciated your rant, and I think we really nailed the key issue going forward for our economy and our society. So it's been my pleasure to tag along.
Talk to you next month.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.